folks, it's true, bull markets traditionally don't die just of old age, and the reason I wanted to bring that up today is because over the past few years, and actually most recently just over the past week or so, as we had a little bit of a dip in the stock market, I've seen a lot of people come out and just kind of already start calling the end of the bull market. So I wanted to give you guys a little bit of perspective of how bull markets actually tend to end. Before that though, quickly, I'm going to be in London, England in early April. So for those of you guys that live in London, England or around there, I know there's a lot of you on there that watch this and a lot of Clubhouse members as well. If you guys want to meet up, I'm happy to meet up anywhere in London. So that's early April. Just shoot me a message through Twitter or email or whatever, or you can just leave a comment down below in the video and I'm happy to meet up with you. And then in the middle to latter part of April, we'll be in Texas. So if you're around in the Arlington, Dallas area, let us know about that as well. Okay, so let's talk a little bit about this whole notion of bull markets dying of old age. Now, the reality is that the sort of cyclical bull markets, which we've been in now, if in US equity market terms, if you look at the S&P 500, essentially is now about 8 years old. And that, historically speaking, is quite old or long in the tooth. If I look at the numbers that I've ran, basically the traditional cyclical bull market is somewhere between 6 and 10 years old long on average. And now this one we're in right now is quite old. And I would argue we've had quite a pause in the bull market into 2015-16 period, but nonetheless the trend has remained higher. So bull markets aren't just going to die just because they're old. The way the bull markets actually tend to end, historically speaking, is if the Fed basically starts hiking interest rates too severely to kind of try to play catch up, and then they kind of overstay their welcome. And right now we're actually in a situation where the Fed is hiking rates. You've got the economy picking up again, the US economy and the European economy picking up again over the past 3, 4, 5, 6 months or so. And that's actually playing in quite well for particularly banking stocks and financial stocks on both sides of the pond. So that's the thing. Keep in mind that stock markets don't just die because, you know, they've rallied for a long time. And so I want to show you guys two specific charts real quick that kind of speaks to this rising interest rate environment that we're seeing in the US right now. It's nothing dramatic in terms of no dramatic increases in rates, but something I think that should bode quite well for financial stocks, banking stocks, and so forth.
All right, here we go. Just two charts real quick. First of all, we have the BKX, which represents the banking stocks in the United States, large cap banking stocks. And you can see at the bottom of the chart, we actually have the yield of the 10-year US Treasury note. Now, if that sounds too complicated for you, let me make it very, very simple. What you can see here is that, of course, banking stocks, along with everything else, have melted higher out of the US financial crisis, the 2007, 8, 9 crisis. And so that's this line here. Now, what you can see, we've had a dramatic rally coming out of the U.S. presidential election. Some of that had to do with the potential of less regulation, and so on and so forth. Now, what you're seeing, though, and this is most important to me, is sort of the structural aspect. If you look at the interest rates, if you take the 10-year Treasury yield from the 2007 highs, and we just draw a line connecting as many dots as possible, you can see that we've had quite a nice breakout in yields, in 10-year Treasury yields here over the past few months. And banking stocks continue to be better bid on that type of move. Now, if the interest rates start to rise too rapidly, too quickly, that's not going to be good for anyone, including financial stocks. But for right now, that's almost like a perfect storm in a good way. It's like a perfect situation for these banking stocks to continue rising over, let's say, the next few months or so. That's chart number one. Chart number two is this one. And this chart basically gives the S&P 500 in blue. And in red, we once again have the BKX. That's that banking stocks index that I just showed you guys in the previous chart. And you can see if we go back far enough, here's the financial crisis tops, and here are the lows. You can see coming out of the recession or out of the financial crisis, that the S&P and the broader market continues to outperform to this day the banking stocks. And I do think that this environment that we're seeing with rates will ultimately be good or continue to be good for banking stocks to finally start catching up and possibly ultimately starting to outperform the broader market.